With the Australian unemployment data released earlier today, we're taking a closer look at how the news affects their economy by talking to Waqas Adenwala, economist with Forecast. So, Waqas, Australia's unemployment data fell from 6.3% in February to 6.1% in March, with significant gains in full-time work helping to somewhat stabilise the unemployment figure for the time being. How is this likely to impact on interest rate cuts in the short term?
Well, if you look at it, RBI has actually been looking at more at CPI and GDP numbers when they've been deciding to cut interest rates in the past, basically in February. Labour is yes, definitely big on their agenda, and from time to time they keep referring back to how terrible situation is in Australia's labour market. But I'm sure if you remember last year, the Australian Bureau of Statistics was quite vague with the numbers they were providing. That led to them being considered quite bad with their credibility. In fact, if you look at it, they're going to change the series again in April 2015, which is the next upcoming data. So after that, they're going to change the spreadsheets again, which means that the data they actually provide has a lot of revisions. So I'm sure if you notice the data that came out early in the morning, they revised the number from 6.3 to 6.2 for unemployment in February. So in that sense, yes, it is a good reflection of data that today's data reflected that full-time employment did go up. But that alone will not be the deciding factor for RBA when they decide to cut or not cut rates in the coming month. I do feel that they're going to cut in May, but that's primarily going to be because of low inflation and GDP concerns, not because of employment. So in that sense, if you look at it, unemployment figure has been low, but it's still above the 6% level, and it's been there above that for the past few months already. That is indeed a cause of concern. So yes, it has stabilized and has been falling, yes, relatively, but it's still not below the level that RBA wants it to be. So in short, yes, RBA is going to consider these data implications for the coming months, which might mean that they might not go cut more than once, but it still means that they are definitely going to cut once, most likely in May, which is the next coming meeting.
In response to Australian unemployment, the Aussie Dollar increased by more than half a US cent to 77.77. Have you forecast a continuation of this strengthening trend for the Aussie Dollar moving forwards?
Well, actually, in-house view for Aussie Dollar is that it will still continue to go down. Yes, temporary data releases like today's did help Aussie Dollar to go up, and that's a big jump actually, that's quite right. But in general, it's actually still going to go down, not because of just one factor, but a couple of them. Firstly, China's a big concern. The Chinese officials have been talking about how sustaining growth above 7% is actually a hard deal. Yesterday, the GDP numbers came out for China, and they were in line, but well, they did also say that there's going to be no risk of a hard landing. But today, Premier Li Keqiang said that having GDP above 7% level is actually a hard deal. So China's a big concern, and you already know about iron ore prices. Treasury Hockey has been talking about how they're not going to tweak the budget to fill in the gaps for falling iron ore prices, but that means that fiscal consolidation again is going to have a negative impact on growth as well. With RBA cutting as well, most likely in the next month, and then Fed probably raising rates at some point in this year as well. All these figures and facts point towards lower Aussie dollar. So yes, a single data point can help to push it up in the immediate aftermath, but it doesn't mean that it's going to be an upward trend for longer than a few days at max. Right. So in general, yes, we do believe that Aussie dollar strengthening is only a short-term phenomenon when the currency is just retracing from its overall downward trend.
Lastly for today, Melbourne Institute survey of consumer inflationary expectations rose by 0.2 percentage points to 3.4% in April. How significant could this be for those traders looking for signs of inflation?
That's right. Well, when inflation actually is pretty much in the spotlight for RBA deciding on cutting or not cutting interest rates, obviously inflation numbers do mean a big deal for traders as well. But in general, they do not look simply at one number as well when they're looking for inflation, or rather predicting inflation in general. For instance, there are better indicators like TDMI indicators for inflation, which actually use the same basket of weights as the ABS does for calculating its inflation. And just a small recap. The Melbourne Institute of Survey is actually a survey of consumer expectations, whereas when they're calculating with the TDMI, it's the same basket of weights as per Australian Bureau of Statistics. And then secondly, you might have been noticing that it actually affects more when you look at the actual basket rather than just consumer expectations. So, for instance, these things like consumer expectations come more into play for across the Tasman Sea in New Zealand, where Governor Wheeler was saying that they will look at that because they're actually quite worried about whether to cut or not to cut or raise in the coming few months. So there is a wide debate where they're talking about consumer expectations. But RBI has so far not signaled about whether they're going to look at consumer expectations. They're mainly going to look at the number itself for inflation. And they're better indicators as well, not just besides TDMI, they also look at house prices, for which a lot of people refer the Riskmark pricing index for Australia, which actually measures the price in house prices for the big cities in the country. And of course, you have the falling oil prices in general as well. They may have recovered a bit last night, but in general, that's a major barometer for transportation costs or fuel costs in the country as well, and then eventually how fuel and oil prices affect all the other industries as well. So yes, when we forecast, we do look at numbers for all possible indicators, including consumer inflationary expectations. But on its own, I think it's not going to have a very significant impact itself.
Thank you, Waqas. Check back with Dukascopy for more updates throughout the week. Goodbye for now.